Welcome back to Basic Business Training 2, and we are wanting to continue in this session looking more closely at the income statement and the balance sheet. If you remember, in our last session, we went through the exercise of looking at the business called SoftBite, and we looked at a new way of looking at transactions, recording them according to the accounting equation, which is assets equals liability plus owner's equity. I really hope that you are able to do some of the practice sessions that we have in your workbook, and you are able to see for yourself how to make sure that you are answering the question, where did these assets come from, or why did this change happen to occur in the business in terms of things going up and down as it relates to the assets, the liabilities, and the owner's equity. And so today we want to take some of that information and we want to put it into an income statement. And I told you that we will be looking at SoftBite, again, the same company, and at their income statement and how what we did can translate into that very simply. But let's go over again, just to refresh our memories, what an income statement is. And so an income statement, when you think about plan, do, review, right, the financial process, it's a matter of taking those transactions now and putting it into a report for us to review. And especially at a manager level, that's what we want to be looking at a monthly basis. And so an income statement is a financial report that shows the result of a business's operations in terms of revenue, expenses, and net income over a period of time. And so the things that you did in that weekly money management worksheet, those are going to be those first few boxes. The income generated, the variable cost, and your fixed cost are all going to be translated onto the income statement. We want to see an income statement that typically is done on a monthly basis. Some people do it on a weekly basis. Some people do it on an annual basis. But our recommendation is that at a minimum, you do it on a monthly basis so that you can see the income and the expenses over the course of 1 month and begin to be able to compare them to each other. Remember that we did also say that a balance sheet, which we will be doing in a few minutes or looking at after the income statement, happens at a point in time and not over a period of time. And so the income statement is something that happens over the period of time. All the income that comes in and the expenses for the variable costs and fixed costs that go out. Some of the terms that you will see on the income statement are terms that we've talked about already, but let's just redefine them, make sure that we're all together on that. The first is revenue. And of course, revenue is what a business earns by providing the services or selling the products to its customers. And so revenues are usually determined by the service or the product. Those can be two different types of revenues. You might have other types of revenues, and you might only use one of those as well. And so you determine for yourself and the business that you're in what type of revenue you are receiving. Remember that the revenue often will come in two forms. One is cash, and the other one is accounts receivable. And that is when a customer takes some of your products or your services on credit and they are going to pay you. That's still money that it's still a sale, a revenue, but you just haven't seen it in terms of cash yet. And so we record it as an accounts receivable. The net income then is when we are looking at the revenue and we are subtracting the different costs that we might have in terms of producing that revenue, any expenses that are being incurred at that time. When we talk about expenses, we are, of course, talking about the cost of doing business. And up until now, we've talked about two main types of expenses. Those are the variable costs, the first one, and those are the costs associated with what the customer takes out of your shop with you or out of the store. The services that you provide are going to have a lesser cost, excuse me, than if you're selling products. Your variable cost will be less if you're providing a service. But then you also have your fixed costs, and of course, those are the costs that you pay regardless of whether or not you have sales. So variable costs vary based on the amount of sales that you might have. Fixed costs have nothing to do with your sales. They are fixed. You pay them regardless of sales, and that would include your rent and your utilities, your transportation, and some of the other things that would be included in the examples that we have given in the past. And those will be also outlined on your income statement. So your net sales, as you're looking at that, you are looking at your revenue minus your variable costs, what the customer takes, and that gives you now your net sales. But it's not your net profit yet, because what we have to do, another word we would call it is your gross profit. Gross would be before we take the rest of those fixed costs out. And so after you go through your variable cost, then you now want to take a look in your income statement, if you have that open in front of you, at the various fixed costs that we want to subtract. So your gross profit is going to be your net sales minus your cost of goods sold. And from there, then, you are going to be subtracting out your fixed costs in order to get you your net profit. All of this is outlined on your income statement, and so if you turn in your workbook to that right now, we're just going to go through what your income statement looks like. And so at the top, you have to make sure you put the name of your business. So this is the income statement for, and hopefully by now you've picked a name for your business. If not, you still have time to do that. That would be a good thing to do. And then underneath that it says for the period of, and this is where you would indicate the period of time that you're covering for this particular income statement. Whether it's a week, whether it's a month, whether it's a quarter, whether it's a year, that would be up to you. Again, from our perspective, it's best to do this on a monthly basis, so you might put the dates in from the first of the month to the end of the month. Then you can see in the top part of your income statement, it talks about sales or revenue. And so that is where now you will go back to those money management worksheets, if you use those, and you will add up the total amount of sales or income that you had from each of those 4 weeks. You add that up, if this is a monthly income statement, and you put the total in. If you have service revenue and you kept track of that, you put in the amount that came from service. If you are selling products, that would go into the sales revenue. If you have other types of revenue that you received, maybe you are renting space as a business to somebody else and they paid you, maybe you received some interest or dividends that were earned, you can enter that into other revenue as well. And then you add that up for the total amount of sales. Then you go to the next part of the income statement, which is the variable cost. And now another way of, again, another term for that is the cost of goods sold. What did it cost you in order to be able to sell those goods? Again, these are relating to what the customer takes away from them. And so again, you go back to those money management sheets, and that was the box right under the income box. That was the second box on that form on the left-hand side. And you want to add up, what did you spend for your variable costs? There are some items that are listed here. You don't have to include anything in your income statement that you don't actually use. You can just cross that out. But some of the items for variable costs, of course, are purchases. What are the things that you had to purchase, the goods, the inventory, the stock, that the customer would directly take with them? The second would be shipping and transportation relating to those specific goods. What did you pay in order to get those goods to your store? Sometimes we forget that we have to hire somebody to help deliver those or to carry them in, and that becomes part of the cost for the variable expenses. The third one listed there is wages, and these are wages that are based on commission. These are not salaried workers. So if you hire someone and they sell on commission to you, you're not paying them a salary. It becomes part not of a fixed cost, which a salary is a fixed cost, but it is part of a variable cost because you will only pay them based on the amount of sales that they actually do. And so if you are paying people on commission, that is the place that you would put that. And you would see that in your money management weekly worksheets. You can add up for the whole month how much did you use for that and put that in that box. And then any other costs that you might have. Again, every business is a little bit different, and the things, the categories you might use are different. And so don't hesitate to write in extra lines if you have other things that are not captured by these 3 lines that are there. After that, you want to add up what was the total amount that you actually spent to get these products or these services out to your customer, and that becomes your total cost of sales, your total variable cost. And now you want to find out what your gross profit is. And so you take your total sales and you subtract your variable cost or your cost of goods sold, and that is going to be giving you your gross profit. Hopefully we're good so far. You've been looking at your money management sheets where you've been tracking the cash that's going in or out, and you're seeing where to add these up and put them into the income statement. And now we go to the next box, which is your fixed cost. And you will see that these items are pretty much alphabetized, not by order of priority, just simply by the alphabet. Again, if you are not using any of these items, if you do not have costs that are involved in your business, you don't have to use them. Some income statements are very short. We have service revenue, we have a few expenses, done. And so don't make this more complicated than it needs to be. But we have all these costs listed because they might be ones that you actually use. So depreciation, and this is something that we have talked about, and it's something that is important for us to understand. Remember, we talked about it in pricing. And if you remember, we talked about the importance of your customer paying for all the equipment that is being used in order to help you do the business. If you are putting that money aside for depreciation, if you are treating that like an expense, that means that you are taking some of the income, putting it towards depreciation, and putting it away in an envelope of sorts so that when that item spoils, you have the money ready to replace it. A lot of business people don't actually do that, and one of the reasons they say is we don't like money to be inactive. So if you are not collecting that money and putting it aside, then don't have depreciation in your income statement as an expense. I've seen sometimes that people say, yes, I know I must be putting something aside for depreciation. They put it in as an expense, but that money is nowhere to be found, and so that's where we begin to have confusion in our bookkeeping. So only if you're setting that money aside do you enter it in here as an expense. Maybe you paid something in the past month for insurance. If you did, it should be in that third box that we're looking at for that money management worksheet. If you're using a different form or transaction analysis, you will be looking at that under your expenses as well. Maybe you have loan interest that you're paying. What did you pay for office supplies, for professional fees, for the rent, the property management, for repairs and maintenance, salaries, and so on? You can see that whole list there. And so for the example that we looked at with SoftBite, we know that they paid for office, or they didn't actually pay for office supplies, but they did pay for salaries and they paid for rent. And so these things are going to show up. And what you want to do then in your income statement is list those expenses based on what actually happened. And from there now, you add up the total amount from your expenses. And you get your net profit by going from taking your gross profit, subtracting the total amount of costs that you had for fixed costs, and that will now give you your net profit. And so let's look at the example that we had with SoftBite. And so in your workbook, you should be able to see the full example. And if you remember, we had assets equals liabilities plus owner's equity. And so in your book, you should see that the last two lines of the owner's equity are revenue and expenses. And I hope that you're looking at it and you can see that the total amount of revenue was $4,500. The total amount of expenses was $1,950. Those two columns right there is your income statement. And that's why using this accounting equation is such a beautiful thing, because I don't have to do any other work to do my income statement. All I have to do is look at my revenue, and I know for SoftBite that my revenue is service revenue, and I see I had two sales, two sources of revenue for a total amount of $4,700, and that's it, done. That gets entered in for income. And then I see that I had 4 expenses during the month, and those expenses were for marketing, $250, for rent, $600, for salaries, $900, and utilities, $200. The total amount of expenses were $1,950. Now you should have in your workbook a copy of what the income statement for SoftBite looks like. And you'll see that if you take $4,700, your income, and you subtract your costs, $1,950, you have a total net profit now of $2,750. And so I hope you can see from the transaction analysis, those two simple columns, revenue minus expenses, how easy it is to make your income statement from that. Now, of course, for a service industry, we have no variable cost. Most service industries, your cost is your time. You're providing a service, not a product for somebody. So SoftBite has nothing to put in that, and I left that in there just so that you could see and we could explain why it's zero. But ultimately, this income statement, if we were to take that portion out, it will be very short. An income statement does not have to be complicated. What money came in? What was the source of that revenue? What money went out in terms of fixed costs or in terms of variable costs, and what was that amount? And then what is our income minus our expenses gives us our net profit. Now, what you will see in here is that this is cash going in and out. What we did not include, of course, is the purchase of equipment or the things that were taken in terms of a liability. And that does not belong on the income statement. That will actually go to the balance sheet. And so what you can see here is just those two columns, very simply presented for the income statement. And so when financial statements are prepared, the sequence would be usually that the income statement is done monthly, whereas the balance sheet is often done annually. And if you are not a business that has many, many products, I would encourage you to do a balance sheet monthly as well, because it gives you a good overall picture of how the business is doing and overall whether your net assets are increasing or whether they are decreasing. So the relationship between an income statement and a balance sheet is that the income statement summarizes the results of an operating period, and those results end up being reflected on the balance sheet. And we're going to look at the balance sheet in just a minute, but that SoftBite example, the assets equals liabilities plus owner's equity, essentially that's your balance sheet. And so you can see how the income statement fits into the balance sheet because it's part of the owner's equity. And so that's what makes it a beautiful picture of all fitting together. So the income statement measures the profitability of your business based on income. The balance sheet is a reflection of the net worth or the value of the business based on those three areas: assets, liabilities, and owner's equity. And so our goal for you in this first part of this session is for you to begin working on your own income statement. I hope by now that you have begun making a habit of recording your income in and your expenses going out so that you have come up with maybe a month's worth of documentation. If you are not there yet, maybe you've done 1 week's worth, you can still take that 1 week and begin to put it into an income statement so you can begin to see for yourself how you are doing. But we want to flow right now right into that balance sheet. And the balance sheet, as I said before, it's like a snapshot at a point in time. And the interesting thing is if you were to take a picture of me right now, within a second, I would move again. And so the balance sheet shows a snapshot at a point in time, but the business continues to move. And that's why sometimes businesses will shut down to do a balance sheet because they have to just stop everything or it'll be done on the weekend. And that is because we are looking at everything that the business has at this particular time: cash, inventory, and all of the other things that go along with that. And so as soon as you write down the cash you have and then you make one sale, that picture has changed. Your inventory has decreased, your cash has increased, and that balance sheet begins to change. So a balance sheet changes very, very quickly, and that's why it's important as well to do these on a monthly basis if you can. It's called a balance sheet because your assets have to balance out with your liability and your owner's equity. And so sometimes the balance sheet is presented side by side so that you can see very easily that those two are supposed to match. You can also do, many people are doing balance sheets more horizontally now with the assets on top and then liabilities and owner's equity. But the goal is that these will balance, that these two numbers come together, so that accounting equation must work. Your assets must be explained by either liabilities or the owner's equity. So just to quickly review again, the current assets, of course, are those things that can be very quickly turned into cash. And so that would include, of course, the cash that you have is a current asset. The accounts receivable are things that people will be giving you money. They owe you money that can be turned into cash. Your inventory is another thing that's a current asset because you can sell those things and turn them into cash. And then there are some blank lines in your balance sheet because you might have something else that is a current asset. It could be your supplies. It could be other things that you have that are something you can turn into cash quickly. Your fixed assets are those assets, those things that the business owns that can't be turned into cash very quickly. And so equipment would be an example of that. We can sell those and we can get cash, but you're not normally going to be doing that. It's more fixed in terms of your business. Land, of course, is another fixed asset, and that's one that typically goes up in value. If you have a building, you want to know what type of value that building has. And the thing to remember, and this is where a balance sheet can get a little bit complex, is that you don't get just to decide for yourself what your land is valued. Either you put in the purchase price, what you paid for it, or you get it reassessed so that you can know what the value is today. But typically, it's not recommended that you say, well, I bought it for this amount 20 years later, and people are telling me it's worth this. I've heard lots of speculation over the years, and usually speculation doesn't really... it's not a good, reliable fact like we like to have with numbers. So if you want to know what it's valued at today, get it reassessed so that you can put the proper amount in there. Same with the building. If you bought the building, what was the value of it? If you built it for yourself, how much money did it cost to put into it? If you want to know what it's valued at today, again, you can get it evaluated so that you can put the correct amount in there. And so you have the different fixed assets that you want to put into your balance sheet. Again, there's a blank line there if there are other things you own, like maybe a vehicle would go in there or things like that. But then you will see in your under your fixed assets, if you're looking in your workbook for the balance sheet, you will see allowance for depreciation. And just to remind you again, everything depreciates. It means it goes down in value. Everything depreciates in this world except usually for land. Land usually appreciates. It goes up in value. Even our bodies will depreciate with time. They go down. They begin having issues. And so as you are looking at your fixed assets, you have to figure in what is the amount of depreciation. Because a minute ago I told you should put in your purchase price. And if you think about a computer, for example, you may have a computer and you may have bought it for a certain amount, but once it's 3 years old, a lot of people will say it's almost worth nothing now. It has depreciated at such a quick rate. And everything that we own will depreciate, will go down in value at different rates. Now, for accountants and for the government, they will tell you, they have a manual that tells you how to depreciate certain things. For a lot of us, it might be difficult to get access to that and to get that information. So what I often ask is that you at least look at it and appraise it realistically as best you can. So for example, the computer that I have, I think it's 3 years old. If I bought it for $500, I would say at most maybe it's worth about $100, $150 right now. What could I get if I were to try to sell this? And that might even be generous. And so we have to think about that. And really what we're saying on the balance sheet is that you will see there's a portion that's in parentheses or in brackets. And that means that you are actually saying, this computer, I listed in my equipment. I listed it at $500, but it's already gone down at least $350. So I put that in as a subtraction. And so some of that is subjective, and it shouldn't really be. When we talk about numbers, it shouldn't be too subjective. It should be reality-based, but that can be a challenge. And so just to get yourself going, just have an estimate of what people might pay for it. If you were to see this computer on the market, what would you be knowing its age and how much it's been used, and the fact that it travels a lot and it's fallen off of podiums a few times, maybe you wouldn't pay that much for it. And so you have to think for yourself, what could I get for this? And you want to subtract that. The whole idea in this is to find out what is the realistic value that your business has for all of its assets. What is the actual net worth of your business? And so this is helpful for you. You don't want to overinflate it because that might cause you problems if you think that you have more assets than you actually have. You also don't want to underdo it because you want to be realistic and get as good of a sense as you can. Then those are the assets, the left-hand side of the equation. Now we want to go to the right-hand side. And as we said before, that the liabilities are often in three different areas. One is the accounts payable. Those things, those items that you owe that are due in less than 30 days. And so if I do a balance sheet and it's September 20, that means, and I normally pay salaries on September 30, that means that on September 20, I owe 20 days of salary. Maybe I get my utility bill on the 25th of the month, and so that's another accounts payable that I have, and so I need to look at 20 days into that utility bill, or 25 days, what do I owe on that utility bill? And so that's where you're going to capture some of those things, and just make sure that you are remembering as much as you can of different places where you are owing money. And that reminds me, I just want to go back to current assets for a minute, that sometimes you have, let's see, prepaid things that we have paid for in advance, and that also is an asset. There are some partners that I've worked with that they have to prepay their rent for a year. And sometimes we've done that, and then we do a balance sheet, and we have forgotten that we're 4 months into that 1-year lease. We still have 8 months of that asset that should be listed on the asset side of your balance sheet. Some of us, a lot of us, prepay for for our phone cards, our scratch cards. And so that is also another asset. Another prepaid item that a lot of us have is insurance. We often pay our insurance at the beginning of the year for a full year. And those are assets that we have that we want to remember to put on the balance sheet. Coming back now to liabilities, as we talk about accounts payable then, or accrued payable, those are the things that we are accruing and paying over time, usually in less than 30 days. But the other liabilities that we have are those short-term loans. And a short-term loan is a loan where you actually have a signed agreement and you agree to pay usually less than 1 year. A long-term loan, a long-term liability is a loan that usually is 1 year plus, whether it's 2 years, 5 years, or it may be a mortgage, which could be 20, 25, or 30 years. And that means usually that it's structured, that nobody can come to you and demand the full amount. You have an agreement for how that will be paid, the amount of fees that you will pay to have access to that, and anybody looking at your balance sheet is going to know that it's going to be structured over time, and you are not going to be called upon to pay the full thing in cash. Lastly, on the balance sheet, we get to the owner's net worth, or the owner's equity. And as we talked about in the example with SoftBite, we start with the owner's capital. How much did you, as the owner, initially put into your business, and how much have you injected into the business since you started? Now, that's not about revenue, okay? That's not about reinvesting from the revenue, from your profit once you subtract your expenses. We're talking about a new capital injection. Maybe an investor has come alongside, or maybe you have inherited some money and you get to put that in, or something else happens. Capital is what you, the owner, have injected into the business. The second then is the owner's draw, and that is the money that you have taken out. The tricky thing on the balance sheet, and this is where it gets a little bit confusing, is it should show the amount of money that you have taken from the business since the day the business began. Most of us have not kept track of that, right? All of the money goes in one pocket, and whenever we need something, we go to that pocket, and when the business needs something, we go to that pocket. And so in a few minutes, I'm going to tell you a way to work around that to still get the answer that you need. But our hope is that going forward, you begin to track how much money are you taking from the business. And I have found this to be a huge encouragement for people. People who say, I'm getting nothing from the business. I'm just doing this business, but I'm getting nothing from it. And what we begin to see as we track over time is what a blessing this business has been to us. And it's an encouragement because suddenly I see how this business that feels like it's getting me nothing, it has helped my children go to school. It has helped to feed us as a family. It has allowed me to support my extended family. I've been able to be a blessing to the church and so on. And so it's important that we begin to write down, to track the amount of money that we, the owner, are taking from the business. And so then we want to be able to come up with our net income, and that is the next part of owner's equity, the owner's net worth. After we have the owner's capital minus the drawings, we want to add in the total amount of revenue. Again, this is a challenge. How much revenue has your business earned since the day it began? It's a number that we don't often have. And then we want to subtract from that revenue all of the expenses, everything that the business has paid for. If you have been keeping track of that, then that's great. It becomes easy for you to do. Most of us, I believe, as you're listening, will say that we have not done very well with that. Maybe you did well for a time and then it fell off. And so here is how we want to be able to answer the question of what to put in there for the owner's net worth, assuming you don't have good records. And essentially it is this. You take your assets, you subtract your liabilities, and now you know what the owner's net worth is. And so that's what we would encourage you to do. If you've been doing your business for a year or 3 years or 7 years, look at what your assets are, because those questions you should be able to answer. Basically, you're saying, what do we have today? You should also know what your liabilities are and know who it is that you owe and what your total liabilities are. And so you can rearrange that equation. Instead of assets equals liabilities plus owner's equity, you can say owner's equity equals assets minus the liabilities. And so that's a number that you can put in there, but again, we don't want to do that more than once because we want to begin dealing with reality and what is really happening on the ground. So I want you to look now at the balance sheet that is in your book, and you will see an interesting arrangement of the balance sheet. And we have done this in order to help you to answer these questions very easily. First, at the top of the balance sheet, you put the name of the business. Underneath that, you will see not a date range, but it says as of a specific day. And so this is where you put the date in, the specific day that you are going to be doing this balance sheet. And then you begin looking at your current assets. And you will see cash, it says A1. And if you look further in your workbook, you will see the question for A1. And A1 says, how much cash does the business have on hand and in the bank or in a SUSU, savings club, etc.? Put that amount in A1. The idea here is to make it easy for you. As you're doing a balance sheet, sometimes it can be a little overwhelming for how to do it. And so we want to make it easy so that you can go look at the question and then fill in the answer. The next one, accounts receivable, is A2. And for that one, you want to ask the question, how much do customers owe the business for completed work? Fill that in A2. And so every one from there, all of the current assets is A1, A2, A3, A4, A5, and then the workbook will also tell you how to do the depreciation. From there you go to the fixed assets, and there you find B1, B2, and again it will help you remember that it's the purchase price that we're looking for. From there we go to the liabilities, and that is D1, D2, D3, D4. And then we go down to the owner's net worth, and we are looking at F1 and so on to the bottom. And so then you have your total assets is C1, and your total liabilities and net worth is G1. And the workbook will tell you as you go through and answer all of these questions how to fill them out. And so I hope that is easy for you, and I hope that as you go through this yourself, you can follow each question, and that each question is simple enough for you to reflect on it. Maybe you have to go around your business and do some calculations and see what you have on hand, and then fill it in. And that's why we don't do a balance sheet very often, especially if we have a lot of different inventory. Because to calculate, especially if you are a pharmacist, if you have a chemist shop, you have to add up all the different pills that you might have and medication, and that can be very time-consuming. And so maybe then you only want to do this once a year or so. But for many of us, we have a service business or we have a few products that we're selling. And so it's good to go around because that's also part of your inventory management. If you do that on a monthly basis, you're going to see very quickly if things are missing, things that maybe you are assuming that you have. And so that is what we want you to fill out, is to do specifically, looking specifically at your balance sheet. And if I can just borrow just a couple more minutes to go over time with you today, I just want to look at the SoftBite balance sheet and specifically looking at the example that we had for SoftBite, and it was assets equals liabilities plus owner's equity. And you will see in your workbook an example of what their balance sheet looks like. And if you go back to that original thing that we looked at where we had the total amount of assets, you will see that it's very easy to do the balance sheet. Cash was $8,050. Accounts receivable was $1,400. Supplies was $1,600. Equipment was $7,000. And then on the other side, we see the liabilities were $1,600. The owner's capital, drawings, revenue, and expenses matched. And so that's what makes this type of worksheet so simple, because it will give you everything that you need for your income statement, revenue minus expenses, and everything that you need for your balance sheet. It will take some practice to do that, but I hope you go through those worksheets and begin to work on it for yourself, following the questions that you need to follow for the balance sheet. Remember as well that you have other activities in your workbook where you can practice these. Precious Asari is an architect, and you can work on her business, or Davis Deliveries is another one that you can work on. Do this together, check with each other, turn it into your facilitators, ask questions, have good conversations. And our prayer and our heart's desire is that you will grow in this and that you will find joy in it as this becomes a discipline that brings you peace and brings you contentment. Thank you so much for your time. God bless you, and have a good day.